Hi, and thank you for watching. We hope you find this video informative and entertaining. This video is brought to you by low VA rates. Today, we're going to talk about whether a 30-year fixed rate is safer than a VA hybrid ARM rate. Most people think a 30-year fixed rate is safer than an adjustable rate mortgage. Some people feel that a 30-year fixed rate is better for people who plan on being in their home for a long time. Others feel that a 30-year fixed rate is better for budgeting purposes, especially for someone on a fixed income or approaching retirement. As for adjustable rate or ARM loans, most people think they're dangerous. Some people think they only make sense if you're not trying to pay your home off and will just move in a few years like someone still on active duty. Assuming a 30-year fixed rate is safer for most people, then obviously an ARM loan must be more dangerous. This is a myth. We're going to compare the 30-year fixed with the VA hybrid ARM loan and explain why a hybrid ARM is usually safer than a 30-year fixed. First, let's define the word safe. Safe, according to the dictionary, means secure from danger or harm, or affording protection. In the context of a mortgage, safety comes from knowing we can afford our mortgage payments. We know how important that safety is because we're homeowners too. The issue is that when most of us start making decisions about our mortgage, we start to get emotional, and being emotional is the worst way to make a decision. So which loan is safer? Well, if our payments on an ARM change over time, our natural thought process is that a 30-year fixed rate is going to provide us the most secure situation. But looking at history, especially the last 10 years, there have been many more times where a hybrid loan would have been safer than a fixed rate. So why is the hybrid loan safer? First, your starting payment will be much lower on a hybrid ARM than on a 30-year fixed. Because your payment is lower, you can pay your home down a lot faster by making more than the minimum payment. If you don't want to pay off your home faster, then you can save hundreds of dollars a month and put it away for a rainy day. Both choices are safer than the 30-year fixed. Imagine paying off credit card debt $200 or $300 a month faster than you are now. I think we can all agree that the less debt you have, the more financially secure you are. Using the right strategies, which our loan officers are happy to go over in depth with you if you are interested, you can pay $25,000 to $35,000 more off your home in the first 5 to 7 years with an ARM loan than with a 30-year fixed. Unless you win the lottery or inherit your uncle's fortune, an ARM is your best bet to pay your home off quicker and pay much less interest over time. But what about the risk of interest rates on an ARM going up over time? On a 30-year fixed, whether in year 1 or year 21, your principal and interest payment will be exactly the same no matter what, even if you've been making more than the minimum payment. Budgeters get very concerned about not being able to plan on what their mortgage payment is going to be, but even on a 30-year fixed, your monthly payment is guaranteed to go up over time. Why? Because of taxes and insurance. The cool thing about VA hybrid loans is that they are reamortized every year after the initial fixed period, which means that your mortgage payment can and will go down as you pay down the balance on your home, even if the interest rate has risen in some cases. If you have a $350,000 fixed rate mortgage and a 4.25% interest rate, you'll be paying about $1,720 a month in principal and interest payments. Let's say you pay that loan down to $250,000 over the next 10 years. You're still at 4.25%, and you're still paying $1,720 in principal and interest. Now let's say someone who took out an ARM loan for the same amount, $350,000, and has paid it down to $250,000 over 10 years, now is at a 5% interest rate because it has gone up. Well, the person with the ARM loan has a principal and interest payment of $1,650 per month, which is less than the person who has a fixed rate, even though the fixed rate loan has a lower interest rate. This is the magic of reamortization. A 30-year fixed never reamortizes. Despite what most people think, the VA hybrid loan is usually much safer for someone looking to have fixed income or heading into retirement, and is a better way to either pay off your home faster or save money for a rainy day no matter where you're at in life. Here's a testimonial from one of our customers. Thank you for watching this video. If you want to learn more about the VA Hybrid ARM loan, please check out our other videos here on YouTube or visit our website at www.lowvarates.com.